Larry, you know what I'm going to do? I am going to start with the toughest thing, which is basically what J.P. Morgan said. Steve, let's get the toughest stuff out of the way so then we can have a little fun. For the stock, says Steve Tusa, the dean from J.P. Morgan on this, or some people feel like it's Ahab. It was a miss, plain and simple, on almost all fronts. Profits were 12 cents below our model, below consensus number at the time of the February pre-announcement. And basically says that, you know what, you got to avoid this thing at all costs. So there, let's get it out of the way and talk about how maybe that view is short-sighted.
Jim, I think we started the year here in 2022 pretty much where we thought we would be and where we talked about this in late January when we wrapped up 2021. We knew this would be a slow start to the year, and I think that's what you saw. But I think we're encouraged by orders being up 13%, very strong demand. You were talking about aerospace a moment ago. We saw that in our own business with orders up well over 30%, and healthcare was also strong. That didn't read through to revenues, unfortunately, because of these supply chain constraints that we've talked about. But we were up 1%, probably would have been up closer to 7% if we didn't have those challenges. But we saw real strength in our revenues and services, up 15%, again, led by aviation, but power as well. So we were really pleased with that. It's a little less exposed to the supply chain constraints. And from a margin and cash perspective, really pleased with the margin expansion of 110 basis points. And our free cash flow was up $1.7 billion year on year. So we know this is going to be a year where sequential improvement, like many years at GE, will be key. We very much over time have proven to be a second half story in many respects. But the combination of that strong underlying demand, led by aviation and healthcare, and the way I think we're improving the ways in which we run the business day in, day out, despite these inflationary pressures, despite what's happening in renewables and obviously in Ukraine, I think we're on our way. I really do.
Well, okay, so you have emphasized that the stock is cheap. Now, you've bought $3 billion in authorization. Is this the kind of thing when you see stock down 7, you go to your board and say, you know what, this is why we have $3 billion in firepower to buy stock?
Well, as you know, the board did recently put that authorization in place for a potential stock buyback. What we're focused on from a capital allocation, Jim, first and foremost, is making sure we set up all three of the companies as we prepare for our two-step spin to have a strong balance sheet, to be investment grade as they prepare for their independent paths, with healthcare going early next year and power and renewables to follow a year after that. So that's really what we're focused on, but we haven't ruled anything out. We want to make sure we stay focused on the spin path. But we're going to look at options, including buybacks, but also other ways in which we might deploy capital to include complementing what we're doing organically with inorganic moves, because there's a lot of potential, again, particularly in aviation and healthcare, but also as we think about renewables and all that will be required for the energy transition. NGE very much intends to lead that energy transition, to be sure.
Well, I hope everyone knows that aviation is good. We can go over it in a second. Everyone knows renewables got issues. Why are you waiting until 2023 for a company like healthcare, which is going to be premier, definitely better than Philips, maybe even with Siemens, and an industry where if you could somehow get, let's say, supply chain issues solved, this might be the gem in a group where people want med tech, Larry, and they want med tech badly.
Well, I think this is going to be an outstanding independent healthcare company. That's clear, Jim. Certainly in the short term, we need to work through those supply chain constraints to make sure our output matches up with our demand. But we've got over 1,000 people hard at work day in, day out, preparing for the healthcare spin. We just announced this program back in November. There's a lot to do to prepare to spin this company. Part of it's a function of the way that we have managed in a more centralized way over time. But we also want to make sure that the business goes out on the strongest possible foundation. So Pete Arduini, our relatively new CEO, and his team, I think, are doing all the right things to position this company to lead in innovation, to really be at the forefront of precision health. We're going to be able to do that in a way that not only drives the top line, but translates into good bottom line and cash performance. So I think this is a company that people will be excited about. I'm excited about my role going forward as non-executive chair. So we need a little bit of time, to complete those preparations, but it's probably now less, as we sit here in late April, less than a year away. And if we can move sooner, we will. But that's the plan of record at the moment.